On March 9th this year, Bapco Energies, the operator of Bahrain's main oil refinery, quietly declared force majeure on its group operations after a second Iranian missile and drone attack on its facility on Sitra Island. A third strike followed on April 5th, igniting a storage tank in a fireball visible across Manama. Last weekend, President Trump rejected Iran's latest peace proposal as totally unacceptable, and U.S. Navy aircraft disabled two Iranian-flagged tankers attempting to breach the blockade in the Gulf of Oman. And yet, more than 10 weeks after the Bahraini refinery first went offline, Western financial markets still appear to have barely priced in what its loss actually means. So in this video, we'll explain why the strike on Bahrain's Bapco refinery has opened up a second choke point in the Gulf alongside the Strait of Hormuz, and why that combination is now showing up directly in fuel prices, refining margins, and inflation data. Never miss an episode and always feel in the loop by subscribing and ringing the bell. First, some context on why Bahrain matters so much here. Bahrain is a small Gulf state, but it hosts the headquarters of the U.S. Fifth Fleet, and its recently modernized Bapco refinery processes around 405,000 barrels per day of refined products for the wider region, up from roughly 267,000 barrels per day before its 2025 expansion. According to regional military data, between February 28th and April 14th this year, Bahrain reported being targeted by 717 missiles and drones, intercepting 194 ballistic missiles and 523 drones over that period. The economic damage has been considerable. Bahrain is now projected to enter a 1.9% recession in 2026, with public debt at 134% of GDP, a budget deficit of around 11%, and a Moody's outlook downgrade in April from stable to negative. And while the New York Times has confirmed that at least 37 energy sites across 9 countries have been damaged since the conflict began on February 28th, the specific knock-on effects of the Bapco force majeure for global refining capacity have been notably underanalyzed in Western financial commentary. So what's actually happened in product markets since the strikes? Well, this is where the story gets interesting. As of early May, the industry standard 3-2-1 crack spread, essentially the margin a refiner earns turning crude into gasoline and diesel, was printing at $56.22 a barrel. Ultra-low sulfur diesel cracks hit a record $86.25 on March 20th, and jet fuel prices have risen by more than 80% since the conflict began. According to the International Energy Agency, European commercial jet fuel inventories now risk falling below the critical 23-day threshold as early as June, with IEA Chief Fatih Birol describing the broader situation as the biggest energy security threat in history. Meanwhile, war risk insurance on Gulf-bound tankers has reportedly moved from around 0.25% of vessel value before the war to between 3 and 10% today, a 12 to 40-fold increase, with many insurers withdrawing coverage entirely. For context, the Strait of Hormuz itself has now been effectively closed to commercial tanker traffic for around 10 to 11 weeks, removing roughly 12 to 13 million barrels per day from global supply. JP Morgan reported an extraordinary 7.1 million barrel per day inventory draw in April alone, and warned that OECD commercial inventories are approaching what it calls operational stress levels by early June. Goldman Sachs estimates only 101 days of demand coverage remain. So why does the Bahrain strike compound this so much? Well, the obvious assumption would be that with crude already in shortage, losing one refinery in one small country is something of a rounding error. But that misses how the Gulf system actually works. Crude oil isn't directly useful to a consumer until it's refined into diesel, gasoline, or jet fuel, and Gulf refineries supply a disproportionate share of those products to Asia, East Africa, and Europe. When you remove the roughly 1.9 million barrels per day of regional refining capacity that the consultancy IIR estimated had gone offline by March 10th, the bottleneck shifts from crude to product. As such, even though crude prices have stabilized somewhat around $106 Brent, the price of the actual fuel that consumers buy keeps climbing because the machinery that turns one into the other has been damaged. This is essentially a second choke point operating in parallel with Hormuz. So what does this mean going forward? Well, US inflation rose to 3.8% in April, driven primarily by energy. JP Morgan's base case now sees Brent in the low $100s of dollars through the rest of 2026, even if the strait reopens, while Morgan Stanley's bull case warns of $130 to $150 Brent if the blockade persists into July. Saudi Aramco CEO Amin Nasser has called it the largest energy supply shock in history and warned that even if a peace deal were signed today, market normalization may not arrive until 2027. The Federal Reserve, having spent 2 years trying to bring inflation back towards target, now faces a second wave it has very little ability to influence. Whether the conflict de-escalates from here, expands to direct strikes on Saudi infrastructure at Ras Tanura or Yanbu, or simply grinds on at the current tempo, remains to be seen. What does seem clear is that the Gulf-wide infrastructure damage already done will keep working its way through fuel prices and CPI prints long after the shooting stops.